Welcome to the very first episode of The Signal, IRWA's monthly briefing on real world assets, tokenization, and what is actually shifting in global finance. I am Maryam, and I have spent the last 10 years in this industry, which means I have survived enough hype cycles to know the difference between a headline and a structural change. In the past couple of weeks, we had both.
And I'm Tar joining from China, and I'm newer to this space, which I genuinely think is useful because I'll ask the questions that people quietly ask and wonder, but rarely speak out loud. So hopefully these are the same questions you're also asking.
Our plan is to produce monthly episodes. Monthly because we want to give you depth, not noise. Every episode we will run through the numbers that actually move the needle, go deep on one major story, look at where regulation is heading, connect it all to what the IRWA ecosystem is building, and close with what this actually means for people who are not yet inside this world.
Well, April and May gave us a lot to work with. Let's get into it.
Let's start with the headline figure. As of the first week of May, the total value of real-world assets held on blockchain, and I'm talking about tokenized government bonds, private credit, real estate, gold, commodities, has reached $30 billion, excluding stable coins.
For context that makes sense to me, that's roughly the GDP for Iceland sitting on blockchain rails.
The growth rate matters more than the absolute number. At the start of 2025, this market was $5.5 billion. It has grown over 400% in 16 months. And crucially, this is not speculative trading volume. The biggest category at around 12 to 13 billion is tokenized US government securities. Short-term treasury bills, the most boring, safe, yield-bearing instrument in traditional finance.
Which tells you this is not some crypto gamblers. This is treasury cash management and institutional allocators, and pension money is also following.
Exactly. And when that cohort moves, they tend not to move back.
So there is actually a story that gets missed a lot here. The broader crypto environment had a bad start to 2026, with Bitcoin being down 10% in January, nearly 15% in February. It had a strong recovery in April, nearly 13%, the first in a year. But even now, it is hovering around 80,000, still well below its all-time in October of 126,000 high. Across crypto and traditional markets, the broader sentiment has been cautious. With geopolitical situation between US and Iran, the uncertainty over the Fed chair, like who is going to be leading the Central Bank of America, and best time ever. All of this has kept risk assets at a complicated place.
And yet, in that same window, RWA tokenization grew consistently. The 30 billion figure held and climbed even during weeks when sentiment trackers were registering what they call extreme fear. That divergence is new. For most of crypto's history, everything moved together with Bitcoin. Bitcoin dipped, everything dipped. RWAs are beginning to behave differently.
They track yield and institutional allocation cycles, not speculation cycles. The 30 billion is not riding Bitcoin's momentum. It's running on a different engine entirely.
Which is exactly why the names attached to this are different than the names usually attached to the whole crypto market. So this is a debt I want to spend a moment on, because I think future historians will point to it.
Yeah, April 16th, 2026. Morgan Stanley, one of the largest wealth management firms on earth with over $1.8 trillion in assets under management, officially declared real world asset tokenization. It's, and I'm quoting directly, next major step in global operation.
So not a pilot or an experiment, but a global business priority.
And they backed it with a specific product. The firm is launching an institutional digital wallet in the second half of this year designed to hold tokenized versions of private equity, bonds, and real estate alongside direct crypto exposure. all in a single regulated interface. Their head of digital asset strategy described the goal as a single cohesive interface for the modern investor's entire portfolio.
So, what does that mean for a normal person?
It means that within the next 12 to 18 months, if you're a Morgan Stanley wealth client, which covers a significant share of world's high net worth individuals and family offices, your financial advisor will be able to offer you a tokenized private equity stake the same way they would offer you a mutual fund today. Same screen, same relationship, different infrastructure underneath.
That's great for Morgan Stanley clients. But what about an individual who is not a high net worth individual? Does this matter at all?
Honestly, right now, directly not much. The first wave of this has been built for people who were already inside the system. Morgan Stanley's wallet, BlackRock's fund, this requires serious capital to access. But the infrastructure being built now is what eventually changes that. We have seen it with ETFs, institutional only products in the 90s, $5 fractional shares today. Tokenization is on a similar path, just faster. There are already platforms where you can hold tokenized assets for $100 or less. They carry more risk than JPMorgan products, but they exist.
Interesting. And just as you mentioned, Morgan Stanley is not alone. BlackRock's tokenized fund built has just crossed over $2 billion in assets. Franklin Templeton, Fidelity, and Ondo Finance are all running production, not pilots. And April was the month where the list of major companies without a tokenized commitment was shorter than the list of those with one.
There's the flip. And once that flip happens at the scale, it tends to be permanent.
And this is happening alongside a bigger shift, actually, on what people think crypto infrastructure is actually for. Stablecoins, the dollar-backed digital tokens, have been around for a long time. Just crossed 300 billion in market cap. Western Union this month, they've just launched their own stablecoin on Solana. Seco, the issuer of USDC, backed by BlackRock and A16Z, they're building their own dedicated blockchain called ARC, which will be mainly for payments and tokenized finance. And these are not just some crypto native companies experimenting stuff. They're legacy financial institutions deciding that on-chain is their future.
Which matters for RWA because stablecoins are the settlement layer. Every time a tokenized asset is redeemed or transferred, something has to carry the dollar value of that transaction. That infrastructure being deep, diverse, and mature is what makes the rest of the IRWA ecosystem actually function at scale.
I read about and send around. Honestly, when I first saw it, I thought it was a typo.
It's not.
On May 6, 4 companies, Ondo Finance, JPMorgan's Connexus platform, MasterCard, and Ripple, they completed what is being called the first ever cross-border and cross-bank transaction on a US Treasury fund. So the blockchain leg for that only took 4.2 seconds.
Yeah, for context, a standard cross-border wire transfer, the kind that moves money between banks in different countries, typically takes 1 to 3 business days, and it only works during the banking hours. This transaction run on a Sunday.
And Maryam, can you walk us through what actually happened? Because I think this is more interesting than just fast settlement.
Yeah, so Ripple held a tokenized position in Ondo's or UCG fund, Ondo's short-term US Treasury product, which carries about 250 million assets under management and over 1,200 institutional holders. They redeemed it on the XRP ledger. Ondo sent payout instructions to MasterCard's multi-token network, which acted as the interoperability layer between the blockchain and the traditional banking system. That triggered JPMorgan's Connexus, which has processed over $3 trillion in cumulative transactions.
Wow.
To deliver actual US dollars to a DBS bank account in Singapore. End to end, one continuous flow.
So the significance is not just speed.
Correct. This is the first confirmed instance of a public blockchain, not private permissioned one, serving as the transport layer for a transaction that terminates directly on the JPMorgan's institutional cash layer. Previous tokenization experiments, including some of JPMorgan's own, ran entirely within closed systems. This one crossed the boundary into public infrastructure. That is the structural distinction that separates this from everything before it. The Digital Asset Market Clarity Act. It passed the US House of Representatives in July last year by a vote of 294 to 134. In plain terms, it draws a legal line between which digital assets are securities under SEC jurisdiction and which are commodities under CFTC jurisdiction. For tokenized real-world assets specifically, that single determination drives every subsequent legal question. Which exchanges can list them, which investor protections apply, which registration requirements kick in.
And where does it stand right now?
The Senate Banking Committee passed the bill on May 14th, a 15-9 bipartisan vote with 2 Democrats crossing over. That cleared the biggest hurdle it faced. Senator Bernie Moreno had set a public deadline back in April. If this bill does not clear Congress by the end of May, digital assets legislation may not pass for years. Congress breaks for summer recess today, May 21st, the day this episode is being recorded.
So we're recording on the deadline.
Literally, we are recording on the deadline. The committee cleared it, but it's not law yet. It still needs a full Senate floor vote, reconciliation with the House version, and a presidential signature. The sticking points heading into that floor debate are a conflict of interest clause around crypto holding government officials and some outstanding law enforcement concerns. Odds have moved from roughly 50 to 50 to somewhere in the 60 to 70% range for 2026 passage. A July 4th signing is being talked about as tight, but not longer impossible.
Well, from China perspective, this is fascinating. We got regulatory clarity in February this year, and the US is still debating it. The usual assumption is that US sets the framework and everyone else follows. But this time the sequencing is inverted.
Yeah, which creates a real competitive pressure. Capital follows certainty, and several jurisdictions are currently offering more of it than Washington.
And this last number is the one that made me surprised when I dug into the data.
Yeah, as of May 18th, 3 days before we recorded this, IRWA.xyz, the primary data tracker for this market, shows more than 790,000 individual holders of tokenized real-world assets globally, up over 7% in the last 30 days.
Well, still small compared to the number of crypto holders, but the direction matters.
Yeah, and the composition is changing as well. Chainalysis tracked Ethereum wallets receiving IRWA tokens within the first 6 months of their creation and found an explosive growth curve sharply accelerating into 2026 after years of flat activity from 2022 to late 2024. For that cohort of users, IRWAs are the reason they came on chain. Not Bitcoin, not DeFi. Tokenized bonds and treasuries. This is a fundamentally different kind of user entry this ecosystem.
So the entry point for blockchain is no longer speculation, it is yield.
That changes almost everything about where this goes next. Let's zoom out. I have watched this space for a decade, and what happened in the last 2 months feels very different to me compared to previous cycles. In my opinion, it's easy to dismiss this as another wave of institutional interest that will eventually back.
So what is actually different this time?
3 things. First, the capital is already committed. This is not a white paper or a press release. BlackRock has $2 billion of client money in its tokenized fund. Morgan Stanley is not announcing a strategy. It's announcing a wallet with a launch date. The institutions that have already built compliance and custody infrastructure now have higher exit costs than entry costs. They're more likely to deepen their position than walk away.
So which means the floor is higher than it has ever been. So is the risk of reversal lower?
Lower, yes, but not gone completely. As I said, exit costs for institutions that already have compliance and custody infrastructure built, they're higher than their entry costs, so the incentive to stay is real, but harder to reverse is not the same as inevitable. The liquidity is still not deep enough, the regulatory picture is still unresolved and very fragmented, and a major custody failure or a high-profile hack of a tokenized institutional product could set confidence back for years. What has changed is that the downside scenario now requires something to go actively wrong, rather than simply failing to gain traction. That is a meaningfully different risk profile from where the space has been 2 years ago. Going back to our main conversation, second thing, the regulatory scaffolding is going up simultaneously across multiple jurisdictions, not fully built, but actively being constructed. The Genius Act gave stablecoins a federal framework in the US. China formally categorized IRWA tokens for the first time. The ERIS MiCA framework is enforcing compliance from any firm operating in Europe. Japan is moving government bonds on chain. These are the world's largest economies, and they are all right now deciding where tokenization fits in their financial architecture. That is a different environment from 2021, when the question was whether any of this would be permitted at all.
The China piece I want to linger on just a little bit because I think it hasn't landed well enough in the Western coverage. February 6, 2026, that notice from the Chinese regulators did not just mean a legal pathway. One of the major Chinese securities firms described it as unregulated growth changing to regulated competition. And I think and believe that the firms that have been quietly building the blockchain capability for years now have a legitimate channel, and the firms that haven't, they're going to have to play catch up. And the firms offshore, especially in Hong Kong, they now sit at a very interesting intersection of the Chinese assets and a global capital market, which gives them an unusual, powerful position, I believe.
Third, the infrastructure worked. The JPMorgan Ondo settlement was not a concept. It was a live transaction on a public blockchain that cleared in under 5 seconds. DTCC, the US securities clearing giant, has announced a pilot for tokenized RWA trading in July. Japan is building infrastructure for government bonds to trade around the clock. These are not aspirational statements, they are operational timelines.
So the capital is in, regulations forming, and the infrastructure is proven.
Yeah, which is a combination the space has not had before at all at the same time.
But let me push back a little bit though, Maryam, because you've been around long enough to have said, this time is different and been wrong.
That is fair. The risks are real. Liquidity remains the most underappreciated one. Putting an asset on chain does not automatically create a buyer for it. Most tokenized products still have limited secondary market trading. You can hold a tokenized piece of real estate. Finding a buyer when you need to sell it is not straightforward. Custody concentration is another live concern, and the Clarity Act, after all, may not pass this year.
Yeah. Well, indeed, like you said, bringing a product to the market doesn't automatically create a buyer. And there's actually something I would like to highlight. The wider crypto environment is a reminder that not everything labeled blockchain is going in the same direction. And April was the worst month for crypto hacks in 3 years, with $651 million lost across 29 separate incidents. That's the security problem. And the speculation problem is just as bad, with the Trump meme coin losing over 80% of its value, wiping $5 billion in market cap. Speculation-driven crypto and infrastructure reward assets are increasingly two different markets wearing the same label.
Which is actually a very useful context. The hacks and the meme coin implosions create exactly the kind of reputational noise that can make serious people dismiss the entire space. However, institutional allocators are not confused about the difference between a speculative token and a tokenized US Treasury. If anything, the contrast sharpens their conviction. They're not here for Trump coin, sorry. They're here because a JPMorgan settlement running in 4 seconds is operationally real.
So the direction is set, but the road is still rough.
The direction is set, and in finance, once institutions of this size commit to a direction, it's very difficult to reverse. The road being rough is a feature of where we are in the cycle, not a signal that destination is wrong.
So let's do a regulation roundup for the month. 3 jurisdictions, 3 different speeds.
Yeah, United States. The picture changed on May 14th. The Senate Banking Committee advanced the Clarity Act in a 15-9 bipartisan vote. That it now needs a full Senate floor vote, needs 60 votes to overcome a filibuster, then House reconciliation, then the president's signature. Congress broke for a recess today as we record this, so the floor vote lands in summer. The ethics amendment, which would have barred senior government officials from holding certain crypto business interests, failed in committee 11-13 and remains the live fault line heading into the floor debate. But the trajectory has shifted. This is no longer a bill that might not happen. This is a bill working out when.
In China has the framework. Offshore tokenization is now formally permitted for Chinese entities, with Hong Kong being the hub. And firms with compliance infrastructure are now ahead at building structural advantage.
Either
Yeah.
MiCA is live and enforcing. The consolidation around compliant players is happening in real time. Europe is not leading in tokenization volume, but is one of the most advanced in regulatory architecture. And the EU is watching the US Clarity Act closely. A clear US framework could accelerate alignment across both.
Can you explain what that means for someone who's not in the US EU regulatory system?
It means the largest Western financial markets are converging on rulebooks for this space simultaneously. The US, EU, UK frameworks aligning matters because it removes friction for products moving between those markets. But it would be wrong to suggest the rest of the world is waiting on them. Singapore has had one of the most sophisticated crypto regulatory frameworks for years. The UAE, particularly Abu Dhabi and Dubai, has built dedicated digital asset regimes that are actively attracting institutional players. Hong Kong is positioning itself as the gateway between Chinese capital and global tokenization markets. These jurisdictions are not watching Europe and the US. In some cases, they are ahead. What convergence across major frameworks actually means is fewer barriers for capital to move between all of them in both directions.
Well, so the rest of the world is not waiting. And Japan is worth flagging as well. Major banks and securities firms are planning to issue government bonds as digital securities this year on blockchain, with the yen-dominated stablecoin for settlement. And the pilot runs through September, but they have commercial deployment plans for targeting 2026. And this is another major economy that's moving from discussion to infrastructure, and with a faster timeline than most of the Western coverage.
Absolutely.
One thing worth noting on the infrastructure side that cuts across all of this is that Bitcoin ETFs in the US just crossed $100 billion in total net assets. And that milestone matters more as a trust signal and less as a crypto story. It means regulated institutional grade on chain products are now a proven thing at scale. And the tooling exists and the regulatory pathway as well exist. And reward assets tokenization is the next product category to run through a similar channel.
At the protocol level, Solana's biggest ever consensus upgrade, called Alpenglow, it went live for testing this week. For context, a significant amount of real-world asset activity, including the bullish equity tokenization, the Western Union stablecoin launch that you mentioned before, is running on Solana. Protocol maturity and stability matter for institutions considering whether to build on top of it. Alpenglow is the kind of infrastructure news that does not make headlines, but tends to make the decisions that follow it much easier.
And for someone who knows Western Union but not Solana, what does a consensus upgrade actually mean? And does it matter?
Well, think of Solana as the national rail network and Alpenglow as a complete overhaul of the signaling system. The trains were running, but at peak times they could slow down, and occasionally there were incidents that shook confidence in the whole line. What Alpenglow changes is the fundamental mechanism by which all the computers running on the network agree on what happened and in what order, which is the thing that determines speed, reliability, and how the network behaves under pressure. For Western Union, that matters in a very practical way. When you're moving real money, even if it's a stable coin, across borders at scale, the last thing you want is the underlying network to hesitate. A consensus upgrade that makes the network faster to finalize transactions and to be more resilient under load is not an abstract technical improvement. It is the difference between a product that works reliably enough to stake a brand reputation on and one that carries too much infrastructure risk for a 170-year-old.
So, Maryam, we've spent most of this episode on the institutional side of real-world assets, Morgan Stanley, JPMorgan, and regulatory frameworks. And I want us to make sure that we address the question that I think most people who come to IRW.
Well, let's be direct. The institutional IRWA story is about moving existing asset classes onto more efficient infrastructure. Treasuries, private credit, real estate, assets that were already worth trillions simply being represented and transferred in a different way. That is genuinely valuable and genuinely transformative for financial markets, but it's not what IRWA is about.
Yes, IRWA is about the value that has never been inside a financial system.
Yep. Think about what you actually do every day. You support things, communities, creators, causes, brands, and ideas. You show up for things that matter to you. That participation has real effects on community, culture, on economies at all, and on what actually gets built and funded in the world. But no existing system recognizes it. It cannot be measured, connected, or made to generate anything back toward the people doing it.
Which is a much older problem than blockchain, right?
Much older. The reason it has not been solved is not lack of trying. It is that you needed specific building blocks that did not exist together until recently. A ledger that anyone can verify, programmable transfer of value, an identity and participation framework that does not require a traditional bank account at the center.
So the institutional world just spent the last 2 years proving that the building blocks work?
That is exactly it. JPMorgan and MasterCard building settlement rails, Morgan Stanley building custody wallets, DTCC building tokenized trading platforms. All of that creates the underlying infrastructure that other applications can run on top of. IRWA is one of those applications, but it is building for a form of value that the institutional story cannot reach on its own.
I want to flag something that I keep coming to here. Point systems that reward participation have long existed, loyalty programs and engagement metrics. A lot of them, though, end up benefiting the platform more than the participant, becoming gamified in ways that dilute the original intent, diluting the participation they were intended to recognize.
This is the right question to ask, and it is the most important design question facing IRWA. We're going to dedicate a full episode to the mechanisms of that, how you recognize genuine participation without creating incentives to fake it. For now, I would rather name the risk clearly than pretend it does not exist.
Well, the institutional side is making the pipes faster. And on the IRWA side, we're asking what should actually flow through them. So every month we're closing here with what all this means for people who are not yet in this world. And we're not going to pretend that the world outside crypto is irrelevant, because with gold hovering near historic heights, And as well with the situation happening in the Middle East, keeping oil above $100 a barrel, and with the uncertainty over the Fed chair, like who's going to be running the Federal Reserve from next month, the question of where to hold value and generate yield is not an abstract one. It is a question every treasurer, every family office, and honestly, everyone with savings is asking right now.
Yeah, so there are four takeaways from April and May.
Yes, and the first is that your savings infrastructure is changing whether you know it or not. If you hold money in any money market fund, a bond fund, or any cash management product, just know that the institution managing those products are actively building systems that move the infrastructure on chain. You will likely never see it happen, but over the next 2 to 3 years, the rails underneath your savings are going to become faster and cheaper to operate and available around the clock. So I think this is good for anyone who is saving on them.
Yeah. Second, what you can invest in is changing as well. Fractional tokenized ownership of assets that were previously only accessible to the ultra wealthy.
Watching from China or with ties to China, the February 6th regulatory notice matters more than it is getting coverage worldwide. For the first time ever, there is a legal structure for Chinese assets to enter the global tokenization market offshore. So the implementation details are still being written, but regulatory openings of this kind usually take months to fully. The firms and individuals building compliance capability right now are building a structural advantage that will compound.
Fourth, the Clarity Act cleared the Senate Banking Committee this week, the week we recorded this. It's not law yet, but the direction has shifted. This is no longer a bill that might not happen, it's a bill working out when. And that alone shifts the ground for everyone in the space, wherever you are based.
So the establishment has arrived, the rails are being built, and the question now is who builds the stations?
That is what we are here to track, the signal for April and May 2026. Next month, we are going to go deeper into two things: the China implementation story, what the offshore tokenization pathway actually looks like in practice, and what is moving through Hong Kong right now, and the aftermath of the Clarity Act, wherever that lands by June.
And I'll spend the month doing significantly more research on this China story for reasons that are, I think, obvious.
Yeah. If someone in your life is trying to understand what is happening in this space but does not know where to start, send them this episode. We built it for exactly that person.
Yes. And if you have questions for next month, find us on LinkedIn. We are IRWA.
See you in June.